When you add stocks to your retirement portfolio, you ideally want companies with long-term growth prospects that also pay a nice dividend, and that's exactly the case for the companies I will mention in this video. So, let's get started. Number 1 dividend stock is Realty Income O. Market value $24.2 billion. Dividend yield 3.6%. Realty Income is an appealing income investment for retirees because it pays dividends every month. Impressively, the company has paid an uninterrupted dividend for 590 consecutive months, one of the best track records of any REIT in the market. Realty Income owns more than 5,900 commercial real estate properties are leased out to more than 260 tenants, including Walgreens, FedEx and Dollar General, operating in 49 industries. These are mostly retail-focused businesses with strong financial health. 49% of Realty Income's rent is derived from tenants with investment-grade ratings. Importantly, Realty Income focuses on single-tenant commercial buildings leased out on a triple net basis. In other words, rents are net of taxes, maintenance and insurance, which tenants are responsible for. This, as well as the long-term nature of its leases, has resulted not only in very predictable cash flow, but earnings growth in 22 of the past 23 years. Number 2 is Verizon, VZ. Market value $250.2 billion. Dividend yield 4.1%. While rival AT&T has aggressively diversified its business into pay TV and media content in recent years, Verizon has remained focused on its core wireless business. In fact, the company even restructured last year to better focus on its rollout of 5G service. Thanks to its investments in network quality, the company remains at the top of RootMetrics rankings of wireless reliability, speed and network performance. These qualities have resulted in a massive subscriber base which, combined with the non-discretionary nature of Verizon's services, make the firm a reliable cash cow. In fact, Verizon and its predecessors have paid uninterrupted dividends for more than 30 years. Its dividend growth rate is hardly impressive. VZ announced a mere 2% uptick this year. But the yield is high among blue-chip dividend stocks, and the almost utility-like nature of its business should let Verizon slowly chug along with similar increases going forward. Number 3 dividend stock is Duke Energy, DUK. Market value $70.1 billion. Dividend yield 3.9%. Duke Energy is about as steady as dividend stocks come. In fact, 2019 was the 93rd straight year that the regulated utility paid a cash dividend on its common stock. The company services approximately 7.7 million retail electric customers across 6 states in the Midwest and Southeast. Duke Energy also distributes natural gas to about 1.6 million customers across the Carolinas, Ohio, Kentucky and Tennessee. Most of these regions are characterized by constructive regulatory relationships and relatively solid demographics. The company also maintains a strong investment-grade credit rating, which supports Duke's dividend and substantial growth plans over the next few years. The utility plans to invest $37.5 billion between 2019 and 2023 to expand its regulated electric and gas earnings base. If everything goes as expected, Duke should generate 4 to 6% annual EPS growth through 2023, driving similar upside in its dividend. Number 4 is Welltower, WELL. Market value $36.1 billion. Dividend yield 3.9%. This healthcare real estate investment trust owns more than 1,700 properties. The bulk of its holdings, 57%, are senior housing buildings, but its portfolio also includes outpatient medical buildings, hospitals and long-term post-acute care. This is a conservatively managed REIT. Besides holding a diverse set of properties, Welltower maintains an investment-grade credit rating and derives 93% of its rent from private pay sources. That's ideal compared to depending on Medicare and Medicaid reimbursements, which can fluctuate because of regulatory changes. This disciplined strategy has enabled Welltower to pay uninterrupted dividends since 1971. That trend seems likely to continue given the industry's long-term prospects. Do you agree with these choices? Yes? No? Tell me what you think in the comments below. And don't forget to subscribe the channel.